Hey everyone, thanks for tuning in. In this first part of the video, I'm going to discuss how to enter a trade on an Australian US dollar currency pair using technical analysis. Obviously, depending on your risk tolerance, time frame and other preferences, there is a number of strategies to choose from, but personally, I do prefer a mixture of price action patterns and trend lines. So, as you can see from this 15-minute chart, my point of interest would start with the formation of this bearish order block marked by this blue line rectangle. As the pair goes through this nosedive move out of the base here, it further confirms, in my opinion, a depletion in bullish sentiment. This is followed by a nice consolidation and then a rapid manipulation up. Before we break down to the downside. The price then starts ranging before retracing higher. Now, zooming into the 1 minute time frame reveals the formation of an ascending trend line as a currency pair makes a series of higher lows. When it comes to tracking prices in the market, trend lines are, I think, rather important since they provide an easy way to monitor which direction prices are currently moving and where they might possibly go next. No matter if a price is heading up or down, drawing a trend line provides a visual reference that helps traders stay focused. The more data points there are to connect, and I think this is important to remember, guys, the more data points there are to connect, the stronger a trend line will be. Also, the viability of the trend line is, I think, directly linked to how many traders or market players recognize it. So the bottom line here is that to monitor price movements and identify trends, it is essential to draw trend lines. Getting back to the trade, if the price drops below the ascending trend line and fails to climb back up, as is the case here, it means that there is a decrease in the demand side of the market. This doesn't ensure a shift in pattern, though. To make sure of this change, we look out for elements like breaks in market structure, which is exactly what we find here, not one but two. Now, this sequence of events prompted the Australian USD pair to slid to fresh intraday lows and dip below the 0.6738 level. The pair then quickly rebounded and began an impressive uptick, propelling it back up to strong levels. At this point, what you want to do is wait for the price to retrace to the supply zone first so it can confirm its validity before you enter a short position with a 7 pip stop loss, which, as you can see, I have placed right above the swing high here. Now, guys, it should be noted that if price doesn't print inside the supply zone, again, to confirm its validity, then you just don't take the trade. As I've mentioned many times before in this channel's videos, no confirmation, no trade. It's simple. Protect yourself with this rule. In the meantime, let's shift back to the 15-minute time frame and take a quick look at the price targets you would set for this type of entry, which from this level here to this level down here would yield some 95 pips. Also, I think it's important to take precautionary measures while still trying to capitalize on potential gains. A great way to do this is using a trailing stop after reaching your first target. I think that this will assist in protecting profits even as you seek out higher second and third targets that can make your trading even more rewarding. So, guys, don't get too comfortable with just one price target reached. Set yourself up for multiple targets by setting a trailing stop. Okay, I guess we are done with this trade analysis, so let's just move on to the next one. Let's take a look at this 60-minute chart of the Euro-USD pair to gain more insight into its movements. On a separate note here, guys, you would be surprised by how much information can be squeezed from a well-observed chart. The different movements of the base quote pair can reveal amazing patterns and hidden trends that could hold the key to predicting the pair's next move. 30 minutes, I think 30 minutes spent zooming in on a chart like this could make all the difference in your next trade, giving you an edge over the rest of the crowd. Okay, so on this hourly chart, we have a prime example of a sideways channel that, as you know, is formed when the support and resistance levels are parallel to one another. Now, the way you try to find a trade here is rather simple. You first look at these price oscillations that are more than just numbers. This is actually an area where you start your trade analysis. By watching, I think, these successive fluctuations of the pair, you are provided with evidence-backed insight in terms of what trading area to consider for an entry. It is possible that this retest here could turn into another reversal move. Now, if price gets rejected again up here, then that's where you should consider your entry point. However, before you do that, you should first switch to a lower time frame to get a more refined view into current price action dynamics. And as you can see, after pulling our 1-minute chart, what immediately stands out is the presence of these liquidity grab areas that create a clear range for us to work within. Now, after this precipitous supply side dipping move, we witness a period of consolidation. Breaking up this choppy rotation is then a strong jump to the upside, moving quickly before finally attempting an intraday high that, as you can see, could not be surmounted. This lower high should be seen, I think, as a strong indicator of the pair's inclination to move lower. What further reinforces this assumption is not only this decline, but also the market's break of structure at this level before imposing to the upside. Obviously, an entry into this imbalance zone here could provide an attractive short opportunity. However, because 1-minute time frames can sometimes be unreliable, waiting for more confirmation before taking the plunge makes sense. In this case, we get that confirmation via another break in market structure. And as the chart shows, after we break structure, we see price reversing and fully closing this time the imbalance zone. So clearly, this is the point where I would enter a short position with a preferred stop loss of 6 pips. My first price target would be at this swing low here, and then another set on this second swing for a 22 pips gain. Alright guys, that should do it for today. I hope you got some value from this video. Thanks for watching and hope to see you in the next one.